The following conversation is intended for informational purposes only. You should always do your own work to determine if an investment is suitable for you. You're listening to the Telltale's Weekend Update. I'm Ava Cabot.
And I'm Marcus Graham, the Cash Flow Desk.
Quick note, the show is produced entirely with AI tools, and both voices you're hearing are AI generated. Send feedback through the Substack. We're still in pilot, so tell us what's working and what isn't. Here's the one thing to take from this week. Memory hit escape velocity. And everything downstream, Apple's price tags, Oracle's balance sheet, the chips hyperscalers are now designing just to get out from under the cost, is a consequence of that one fact. On Wednesday's show, episode 2626, Hunt, Jason, and Mike flagged the memory squeeze forcing Apple to raise prices. Then Micron reported, and the squeeze stopped looking like a cycle and started looking like a supercycle. Start where it hits you at the checkout. Apple just told you the memory shortage has reached the price tag. The company raised prices on 14 products this week. MacBooks up $200, the iPad up to $449, Vision Pro now $3,700. The stock had its worst day in over a year, down about 6%, roughly $265 billion of market value gone in a session. And Tim Cook didn't hedge it. He told the Wall Street Journal memory and storage prices have quadrupled in 3 quarters and called it, quote, a 100-year flood, unlike anything he's seen in over 40 years. And then the quiet part. The same week Apple raised your prices, it was lobbying the Trump administration for permission to buy memory from Changshin, a Chinese maker that sits on the Pentagon's blacklist. That's how short memory is, and the talent is chasing the same scarcity. Apple's head of Vision Pro and smart glasses engineering left this week for OpenAI's hardware unit after 7 years on the project. Marcus, Apple can afford to eat this. Why is it passing it on?
Because the flood is real, and Apple is telling you it can't source its way around it. This is a company that prints cash. The memo had Apple at 35 times, trailing free cash flow at a roughly 3% yield going in, on about $130 billion of trailing free cash flow. A company with that cash machine raises prices on the customer only when the input cost is structural, not a blip. The price hikes aren't the story. The lobbying to buy from a blacklisted supplier is the story. That's a hardware company admitting the supply chain it actually wants is the one it's not allowed to use.
From the checkout to the data center, Oracle is building the AI cloud with borrowed money and a shrinking payroll. The company cut 21,000 jobs over the past year, about 13% of the workforce, while it pours money into infrastructure. Free cash flow for fiscal 2026 swung to a deficit of nearly $24 billion, driven by $56 billion in capital spending, and it's guiding next year to $90 billion in revenue while planning to raise another $40 billion in debt. Marcus, what does that infrastructure actually cost?
It costs the balance sheet, and Oracle's making that bet out loud. There's no multiple to anchor here. When you spend $56 billion on capex and free cash flow runs a $24 billion deficit, the price to cash flow frame just doesn't apply. So don't pretend it does. What you're actually underwriting is whether all that borrowed capacity turns into durable cloud revenue or into stranded data centers.
A bet, not a business yet.
Not yet. And the tell will be the financing. Oracle already raised $43 billion in debt this past year, and it's planning $40 billion more. When a company funds the build with the bond market instead of its own cash flow, the bond market gets a vote on the strategy. On page 2 of the memo, Oracle sits right next to Broadcom, the two sides of the same AI infrastructure trade. One is borrowing to build it. The other is selling the shovels at a profit. Hold that thought.
Here's the deep dive, and it's really one argument. Same week, same end market, 2 completely different stories. Micron printed the memory supercycle in raw numbers. Broadcom showed you exactly what the hyperscalers will pay to escape its downstream cost. 2 sides of one trade. The headlines, side by side. Micron reported fiscal third quarter revenue of $41.5 billion against prior guidance of around $24 billion, and then guided next quarter to $50 billion when Wall Street was modeling 43. The stock jumped 16% and the market cap crossed $1 trillion. Meanwhile, Broadcom and OpenAI unveiled a custom inference chip called Jalapeno, built to cut AI inference cost by about half versus a standard GPU. Marcus, which one is the bigger surprise?
Micron, and it's not close. Going into this print, the memo had Micron at 102 times trailing free cash flow. And I want to be clear, those numbers are now ancient history. We re-anchor when the fiscal year filing lands. Forget the multiple. The thing that matters is buried in the release. 16 legally binding take-or-pay contracts that lock in about a fifth of Micron's DRAM capacity through the end of the decade. That's not a cycle. A cycle is when prices spike and supply floods in to kill them. This is customers signing multi-year contracts to guarantee they get product at all. The cycle didn't turn, the structure changed.
But every memory bull has been burned by the next air pocket. What stops this from rolling over the way it always has?
The mix. Micron's data center revenue went up more than sevenfold year over year to about $11.5 billion in the quarter. The old memory cycle ran on phones and PCs, discretionary demand that turns on a dime. This run is driven by AI training and inference clusters, where the buyer is a hyperscaler, signing multi-year capacity. Contracted demand doesn't air pocket the way discretionary demand does. The real risk isn't a sudden glut, it's that the build pauses, and the take-or-pay contracts are written so that even if a customer pauses, Micron still gets paid. That's the difference between this and 2018.
So, why is Broadcom the other half of this?
Because jalapeno is what you do when the input you depend on just got that expensive. Broadcom's memo profile is the mirror image of Micron's, about 68 times trailing free cash flow at a 1.5% yield, a real cash generator priced like one. And its AI chip revenue is already scaling toward more than $100 billion next fiscal year. The jalapeno chip, 50% cheaper inference, co-designed with OpenAI, is the hyperscalers saying out loud that GPU economics hurt enough to design around. NVIDIA is the chip everyone's now trying to engineer their way past. That's not a knock on NVIDIA. That's a tell on how expensive the whole stack got.
And does Jalapeno actually dent NVIDIA, or is it a negotiating chip?
Both, and that's the point. One custom processor doesn't break a software moat built over more than a decade, but it changes every procurement meeting. Now the hyperscaler has a credible second source to wave around. The forward test for Broadcom is just as simple. Does that $100 billion fiscal 27 AI number actually show up, or does it stay a slide and a deck? If it shows up, 68 times trailing was cheap. If it slips, it was the top. Either way, Broadcom gets paid to build the escape hatch. Here's the line that ties it together. Memory is the new crude oil, and like crude, the people who locked in supply before the price doubled look smarter every single quarter. Micron just signed the people who locked in.
Memory is the new crude oil. Sit with that one. Rapid fire. Step away from memory for a minute. Nike is the turnaround that keeps not arriving, and Tuesday it gets graded. The company reports fourth quarter results Tuesday afternoon, with the stock sitting at a 52-week low of $40, down about 35% on the year. KeyBank downgraded it this week on slow turnaround progress and headwinds in China and Europe. And here's the crossover detail. Nike's new finance chief is David Denton, hired straight out of the Pfizer CFO seat. Which brings us to pharma, where the week was busy. On page 15 of the memo, Pfizer and Moderna. Pfizer got an FDA approval expanding its Ibrance breast cancer regimen, and it's pushing 10 phase 3 studies this year on its monthly GLP-1, berobenatide fowler, the obesity option the market isn't really pricing. Pfizer trades around 16 times free cash flow at a 6% yield, so you're paid to wait. And Moderna got a unanimous 9-0 FDA advisory vote backing its mRNA flu vaccine, with a decision due August 5th, which would be the first mRNA flu shot licensed in the U.S. The stock jumped about 12% on the news. Two names, one page, two very different clocks. Pfizer's a yield and optionality story you can hold. Moderna's a binary that resolves August 5th. Meta showed you the memory supercycle hitting the biggest ad budget in tech. It raised its 2026 capital spending guide to between $125 and $145 billion, blaming higher component pricing and data center costs. Same flood, different shore. It also unveiled in-house AI smart glasses at $299 in a prediction market app called Arena. and Tesla, the number to watch, lands Thursday. Tesla reports second quarter deliveries July 2nd, with consensus around 406,000 vehicles and Goldman up at 420,000 on a European recovery. One analyst cut the stock to sell this week, citing energy storage revenue down 12% and robo-taxi delays. The delivery print is the first real read on whether Europe offsets China. That's the show. Wall Street's consensus on Micron, the memory cycle always rolls over, it always has. 16 take-or-pay contracts running through 2030 say maybe not this time. Keep score with me on that one. Forward week, Nike reports Tuesday, Tesla deliveries Thursday, and Moderna's FDA clock runs toward August 5th. Everything you heard today traces back to one chart, the price of memory, and the cash flow memo is where we watch it propagate through all 90-plus names. Download it at telltales.us. Hunt, Jason, and Mike are back Wednesday on episode 2627. The views expressed on this podcast are the host alone and do not constitute an offer to sell or a recommendation to purchase or a solicitation of an offer to buy any security, nor a recommendation for any investment product or service. While certain information contained herein has been obtained from sources believed to be reliable, neither the host nor any of their employers or their affiliates have independently verified this information, and its accuracy and completeness cannot be guaranteed. Accordingly, no representation or warranty, express or implied, is made as to, and no reliance should be placed on, the fairness, accuracy, timeliness, or completeness of this information. The host and all employers and their affiliated persons assume no liability for this information and no obligation to update the information or analysis contained herein in the future, and may or may not hold positions in the securities mentioned.